I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead-zinc-silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic engineer gold mine in the Atlan District of Northwestern BC. Check us out at blindcreekresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Victor Adair, co-founder of the Polar Futures Group. He's Senior Vice President and Derivatives Portfolio Manager at PI Financial in Vancouver. His website, polarfuturesgroup.com. Welcome back to the show, Victor.
Well, thank you, Jim. Good to talk to you again today, as always.
For the past several months, you've been bullish on the U.S. dollar. Do you think it's still going to continue its upward trend?
Well, let's see. That's a yes and no question, but let me divide it up this way. Let's start with time frame, because that's very important. Longer term, yes, I do. Just in the very short term now. By short term, for me, that means maybe over the next couple of weeks, that kind of thing. I think maybe we could see the U.S. dollar back off a little bit. To take the bigger picture, you know, the all-time low in the U.S. dollar index, which we watch, and that's heavily weighted against the euro, was made in 2008. I thought the recent rally in the U.S. dollar really started around 2011, which was a time, by the way, when commodity markets, you know, made their recent highs. Gold made their high that 2011. Since 2011, the U.S. dollar rallied about 40%. When I say the U.S. dollar, I gotta say the index rallied about 40% to the highs just after Trump's election, and then it went into a slump for about a year. Since April of this year, the U.S. dollar index has rallied against the other currencies. Now, the rally has been in kind of two parts. On the show here in the past couple of months, I've talked about the stealth strength of the U.S. dollar, and by that I meant that it was the emerging market currencies that really fell against the U.S. dollar, whereas, call it the G10 currencies, not so much. I mean, everybody heard about how the Turkish lira was falling, or the Argentinian peso, and so on, but a number of other currencies, including countries like India, big economy, India, the rupee, they're trading at all-time lows against the U.S. dollar. So there's this time frame when you look at where I think the U.S. dollar is going, and then U.S. dollar against what? So to come back to the time frame side, I think that probably one of the things that I really pay attention to with currency trading in particular is what I would call sentiment. Just, what's the investor psychology in the market? It seems to be more important, I think, in currencies than any other market. And since April, the market's kind of swung to a pretty bullish U.S. dollar view. I think it's maybe a little bit overdone and could go the other way. For instance, here's a good example. For instance, for Canadians here, the Canadian dollar is at an 8-year high against the Australian dollar. So the Australian dollar was a little bit more in the camp of emerging market currencies, while the Canadian dollar was in the camp of developed market currencies. So currencies like the Aussie and the New Zealand got dragged down more with the weakness in things like, say, South Africa, certainly almost all of the South American currencies. So if you had a view, and this is something I'm looking at doing, that the U.S. dollar strength was overdone and we might get some weakness in the U.S. dollar, you could do a trade like buy Australia and sell Canada against it. And, of course, there's lots of other trades as well.
Well, the Canadian dollar's trading around 77 cents. It's weakened against the U.S. dollar, but it's up against a lot of other currencies. Where does it go from here? Yeah, I mean, Canada, okay, let's kind of go over the main things that seem to create the value or create the price of the Canadian dollar. One of them would be the strength or weakness of the U.S. dollar against most other currencies.
Another thing is the relative interest rate differential between Canada and the United States. And a third major thing is how commodity markets are doing, and that kind of helps create the Canadian dollar price. So U.S. dollar has been generally strong. I think in some respects, capital has flowed from the rest of the world to the United States, and some of that capital might have just spilled over into Canada because Canada has gone up against most other currencies in the world. And when that capital comes to America, it comes for what I call safety and opportunity. So maybe the rest of the world looking thought, Canada, the United States, you could put some in one country, some in the other country. Could have been some of that. It's unusual to see the Canadian dollar steady to rising a bit here as it has the past few months, while commodity indices generally have been going down. Now, then we have certainly shorter term things like worries about NAFTA. It's interesting that the Canadian dollar actually has done as well as it has, given the worries that we have around NAFTA. U.S. tax policies, I think, have been favorable to the United States. And on the difference of interest rates, the view, I think, in the market is that the Fed is going to be tightening more while Canada, Bank of Canada that is less liable to tighten. So interest rate differentials should be favoring the United States dollar. Take that all into account. We've had the Canadian dollar rally about a penny or so, or a little better than a penny from last week's lows. Part of that, I think, is some enthusiasm that maybe a NAFTA deal gets done. And I think just generally the weakness in the U.S. dollar against most currencies, and that's relative weakness here the past week or so, has given Canada a lift. I think if we say from now into spring of next year, I would think that the U.S. dollar is favored, maybe for only the one reason that I think the Federal Reserve is likely to tighten interest rates more than the Bank of Canada will, and I think that'll widen the interest rate spread and give Canada a real headwind.
Can you explain why, when there's a difference in interest rates, why one currency is favored over another?
Yeah, sure. It could be just as simple as let's say you're in country X, and you have a choice to put some investments in country A or country B. Country A, the interest rate is a lot higher than in country B. Now, sometimes interest rates are higher, like say they are in Argentina, because they need to be higher or there'd be no capital go there. But really, relative interest rates give an edge to one currency over another just in terms of return. Now, I've talked many times here, I guess, on the show over the past few months about how it's puzzled me at times how capital will flow to the European currency, the euro, when you have German interest rates, let's say at a 2-year term, more than 3 full basis points below American rates. It's like, God, who would make that trade? Why would you put money into Europe when you got to give up 3% over what you could get by putting your money in America? So it's not always a factor, but I should say it's not always the most important factor, but it's always a factor when you're making a decision.
We'll have more with Victor Adair right after the break.
I'm Greg Johnston, CEO of Carl Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Carl Data offers machine learning and predictive analytics features to our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Carl Data trades on the CSE, symbol CRL, and the Pink, symbol CDTAF. For more details on Carl Data, please visit carlsolutions.com.
Media recognition from Bloomberg, Reuters, Recycling Trade Publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Victor Adair. Victor, going back to interest rates, how does Switzerland expect anybody to invest in its bonds when they have negative interest rates?
Oh, they don't want you to. believe me, the Swiss are concerned that money leaving other places, like the euro or elsewhere, and coming to Switzerland is pushing up the value of the Swiss franc and making them uncompetitive with their exports. Okay, so no, the Swiss don't want your money. It's like, go away. That's really the reason they've got negative interest rates.
The major U.S. stock market indexes fell about 12% from late January to early February, but have been rising since then, with a number of indices making new all-time highs. But a lot of other global stock markets have continued lower after the January break. Do you think this is related to the U.S. dollar?
Yeah, definitely. As I said earlier about capital comes to America for safety and opportunity. Picture this. Just picture a circle. And the center is the safest place, and the outside edge of the circle is called the periphery, and it's less safe in terms of distribution of capital. When people are feeling frisky, the market's kind of got a risk-on attitude, capital is willing to take on more risk, so it moves away from the center. And the further away from you go from the center, the more risk you're taking, but perhaps you're also getting higher return, which is what attracts the capital. Then when capital gets a little nervous, it comes back to the safety of the center, and that's the way I view things. So we had this environment of the last few years where emerging markets borrowed trillions of U.S. dollars at relatively low interest rates to fund or fuel their economic growth. As interest rates rose, and particularly as their currency started to fall, you got a vicious circle happening where it was harder and harder for those countries to, say, service the debt, pay back the money that they'd borrowed. And as investors realized there was credit problems ahead, they pulled hot money out of those economies, brought it back to states, exacerbating the problem. So, in three sentences, that's probably kind of describes why we've had this real pressure on emerging markets. It's been tied to the U.S. dollar very directly and the fact that U.S. interest rates were rising. Now, the U.S. stock market has, as you say, had that fall back in January, early February, rallied back. The major indices made new all-time highs here, while in the rest of the world, and by the way, just roughly speaking, the rest of the world accounts for about 70% of total stock market capitalization. So America accounts for about 30%. Forgive me for being wrong for a point or two, but just for order of magnitude. So in the rest of the world, you've had these stock markets really fall, and in their falling, and it's not just, by the way, the stock market. Obviously, their currencies were weaker, but credit markets were weaker. Interest rates in some of these other countries have had to jump huge to try to retain capital. I think the relative strength and weakness in the stock market has been very much a function of the U.S. dollar when you look at it from a global perspective.
We'll have more with Victor Adair right after this.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the Pink CYDVF, and on Frankfurt's C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Victor Adair. Victor, one of my frequent guests came back from a seminar in Oxford where they talked about monetary policies, and they talked about the creation of money. And they said basically money is created in our system when banks lend you money for a mortgage, because they don't really have that sitting there in a vault somewhere. They just punch some numbers into a computer and assign them to somebody else to purchase the house. In other words, they're creating about 75% of our currency when somebody builds or buys a home. Do you buy into that theory?
Oh, that's people put money into a bank. Banks lend it out, and they need to keep a reserve in case loans go bad. I mean, that's basic banking. That's how it works. And when the central bank pulls cash out of the banking system, that tightens the system, probably pushes interest rates up, and the reverse happens when the central bank pushes money into the banking system. That's how the central bank's one of the main levers that they have for controlling interest rates and controlling, let's call it, irrational exuberance in the economy. So, broadly speaking, yeah, I'd agree with that.
A couple of months ago, you talked about how politics had replaced central bank policy as the most important market driver. Do you still think that's the case?
Yes, it's not like central banks went away, and we could maybe come back to that in a minute, that central banks are still obviously very important. But yeah, the focus has, and maybe they were just so important for so long, and just like a bunch of kids, you know, the investors needed something new to attract their attention. But when we say politics, let's just use the word Trump, you know, cut to the chase. Trade wars, which he has initiated, and sometimes I wonder if he didn't do that because I view this president as not a team player. He likes to, my way or the highway, do his own thing, and he discovered that he could actually go out and put trade sanctions on other countries or erect tariffs without having to get agreement with Congress. But we just go to trade wars. There's basically three parts. There's China, there's the EU, and then there's NAFTA. I have this thought, I mean, the way of looking at things, that the market has been very worried about the impact of, call it tit-for-tat, rising tariffs on both sides. I think it's been a big concern for business and hence some worries in the market. And, you know, just look at Canada. I think if we suddenly had a headline that the Americans and the Canadians have had a little love fest, and you know NAFTA's back, and we're all buds again, and there's not going to be any tariffs on Canadian car exports going into America, whatever. Just in the past couple of days, there's been a hint of that, and we've seen the Canadian dollar have a rally. So I think the real key is the one with China, and you could argue about whether or not Trump is right or wrong in his view of China as a mercantilist economy. I understand, I should say, I think that Trump kind of believes that the rest of the world has taken advantage of America, and he thinks that's wrong, and he wants to correct it. Okay? If that's what he thinks, then, you know, maybe the trade wars don't end that quickly. But now, to answer your question, have politics replaced the central banks? Yeah, kind of in terms of, you know, front and center, what's the first headline on your screen in the morning? It would be a great relief, for instance, to the stock market, and the stock market would probably go higher if the trade war issue was settled. You know, let's say some people might estimate that something will happen before the midterm elections coming up in November. I find it difficult personally I don't think I've got any ability to handicap, you know, what Trump is up to next, or how these developments are going to play out. So it would probably be easier for me if it wasn't there to deal with, and I could just look at the central banks. But politics has really roiled the market, you know, made it more choppy maybe than it would be otherwise. So it's been an important driver.
Staying with central banks, do you think the U.S. Fed is going to keep raising interest rates?
Yes, I do. And I think the market's priced that way. There'd be some people that I read that think the market's pricing in too much, or they think it's pricing in too little. But I mean, just for instance, given, you know, the tax cuts that happened in the United States earlier this year, deregulation that's been going on since Trump was elected, we're seeing the optimism amongst small businesses in the United States is at a 50-year high. Employment is strong in the United States. Wages are rising. I think this is an ideal prescription for the central bank to want to, in the old expression, take away the punch bowl. You know, they don't want the things to get too exciting, or they certainly don't want to see inflation run away to the upside. Inflation has been rising a bit. So on the other side, their concern might be that given what's happened with some of the stock markets around the world, we've got major bear markets in some stock markets. If we had contagion come back to America, you might think that the Fed would back off. But so far the indications are that Powell, and it's a new Fed I describe under him, is going to maintain this path that they've laid out of rising rates by about 1/4 of a percentage point every 3 months or so. I think that's still on the table.
You've often said the strength or weakness of the U.S. dollar is key to the price of gold. Gold fell about $200 from April to the August lows and has bounced back about $30. Where do you think it goes from here?
Yeah, gold really got beat up this year, particularly from the turn around April, May, when the U.S. dollar started to strengthen. And yes, the one of the keys, if not the key, determinant of the gold price is the relative strength or weakness of the U.S. dollar. And when we started the interview here, I said, I think maybe, the U.S. dollar might weaken a little bit here. My good friend, and I know you interview Ross Clark. Ross has been a friend of mine for years. Just put a piece out this morning about how he is, with his technical interpretation, sees that the shares of gold mining companies have capitulated, is the word he uses. In other words, that they've made this dreadful low after being under pressure for so long, and that could set them up for a bit of a pop to the upside. We've seen in the markets that I trade, what we call the commitment of traders data, we had speculators turn negative gold, in other words, net short, for the first time, I think, since 2002 or something. It was a good 15 years since they had been negative. And just by comparison, back in the summer of 2016 when we had Brexit, we had speculators massively long gold, the longest they'd been in a long time, and that marked a recent high for gold. So now when they're positioned the other way, it may be marking a low for gold. And just to put that into context, I know I've talked before about gold relative to the S&P and, it's unloved, but just the commodity indices generally, relative to the S&P index, to use a stock market benchmark, okay? So the ratio then between commodities and stocks is at a 50-year low. Commodities are down about 75% in the last 7 years since they had their high in 2011, 2012, against the stock market. So in other words, capital has gone into stocks and away from commodities. So I'm not calling the turn here, but I'm just saying for people that are contrarians or value investors, you might say there's some value here in commodities relative to stocks.
Oil's been trading below $50 a year ago. Then it went up to around $70 the last few months. What's your thoughts on crude? Yeah,
crude's been a tough one for me, honestly. If I look at the classic supply-demand, and that even gets tricky, but certainly one of the functions right now is what's going to happen with Iran. Is there going to be a vacuum of, let's say, 1 million barrels plus a day come off the market as the sanctions from America get applied? Will other countries, whether they're in OPEC or outside like Russia, make up for what Iran is not pushing onto the world market? And then there's the disaster of Venezuela as their production continues to fall. America, their production has been rising, but it looks possibly like production there may slow, or at least the rate of increase might slow as the takeaway capacity. They don't have the pipelines to get it out of the ground and over to the refinery. So, and then given another function, the positioning in the market, speculators had been massively long of crude oil, but they've kind of tapered that back a little bit. And then on the demand side, you have to wonder you go around the world and see these emerging markets getting clobbered, at least financially as they are. Is that going to mean a slowing in demand? I'm a little puzzled with crude. I haven't been trading it much. I had done very well trading crude from the short side back in 2014-15, and I know I developed a bias, I guess, looking for some weakness in crude. I mean, the last couple of days, we've had crude jump, I don't know, $3 at least on WTI, just with the concerns about Hurricane Florence approaching the United States. That jump, and that's taken Brent up over $80 a barrel. It's tempting to me to want to say, okay, I want to use that little strength as an opportunity to get short, but I'm holding fire on that right now. I could also see if it trades, let's say, another few dollars higher, maybe it's off to the races to the upside. So I'm not trading it. I don't have a strong opinion, and I'm just going to watch it and see which way it goes. And like the classic mercenary soldier, I want to be on the winning side.
Victor, I don't know if you have much on lumber, but last year we saw record highs for lumber. Then it's fallen. But BC's had its second record-setting forest fire year, which means a tighter lumber supply, plus, again, major hurricanes rolling into the southern U.S., and they'll have to rebuild. Will that see lumber stocks go up?
Well, that is a classic to have lumber bought when there's hurricanes in the States. I mean, Hurricane Katrina, remember that a few years ago, created a big demand for lumber. But you're right. I mean, in early May, I guess, of this year, we had lumber around $600. And just looking at my screen right now, we're below $400. So it's come off pretty hard. I think if you were going to trade lumber, and I don't trade it much, and I think you just need to be prepared that could be a very volatile market. And I would not recommend, and I certainly wouldn't do this myself, to go out and buy some lumber just because I thought there was going to be some demand from the hurricane. It could well be that, but there's a lot of other factors in the lumber market. It's a relatively thin market. It's had some very volatile price actions that I just described, so I'd be cautious about that.
Victor, thank you so much for chatting with us.
Tom, pardon me, Jim, it really is always a pleasure. Thanks very much.
My guest has been Victor Adair, co-founder of the Polar Futures Group, his website, polarfuturesgroup.com. You're listening to HowStreet.com radio. You can find us on Twitter at HowStreet. Questions for our guests or the show can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.